Hello everyone, and welcome to Unit 10 of our educational series, Stock Investing 101. In today's video, we'll be discussing one of the most popular topics among investors and traders. In our previous videos, we discussed what stocks and the stock market are. Now, let's move on to how to find good stocks. It's important to note that different investors may use different techniques or a combination of these techniques based on their investing style and risk tolerance. There are three primary techniques that investors use to find good stocks: technical analysis, qualitative analysis, and fundamental analysis. Let's go into the details of each of these techniques. The first technique is technical analysis. Technical analysis is a type of investment analysis that focuses on the study of past market data, primarily price and volume, to identify patterns and trends in order to predict future market behavior. In the context of stocks, technical analysis involves using charts and other technical indicators to analyze historical price movements and identify potential buying or selling opportunities. Some common technical analysis tools used in stock trading include moving averages, trend lines, support and resistance levels, and chart patterns such as head and shoulders, double tops and bottoms, and triangles. Technical analysts may also use oscillators and other indicators, such as the Relative Strength Index, RSI, or Moving Average Convergence Divergence, MACD, to help identify momentum and potential turning points in the market. One of the key concepts in technical analysis is market psychology. Technical analysts believe that market participants are influenced by emotions such as fear and greed, and that these emotions can be reflected in price movements. By studying historical price movements and identifying patterns and trends, technical analysts attempt to gain insight into the underlying psychology of market participants and use this information to make predictions about future price movements. However, this strategy is mostly used by traders for day trading, and as long-term investors, we should avoid this strategy. The second technique is qualitative analysis. Qualitative analysis involves assessing a company's strengths and weaknesses based on non-numerical data such as market trends, customer preferences, and industry outlook. This type of analysis is often used with fundamental analysis to provide a complete picture of a company's position within its industry and its potential for growth and profitability. It is very similar to finding the economic moat of a company. Warren Buffett once said in one of his annual reports, "What we're trying to do is we're trying to find a business with a wide and long-lasting moat around it, protecting a terrific economic castle with an honest lord in charge of the castle." The main risk for any company is its competitors, who try to take away its customers and profits. A perfect company has a competitive advantage that acts like a protective barrier, preventing rivals from stealing its market share. The wider and stronger the advantage, the safer the company is from potential threats. Here are examples of 10 qualitative factors and their impact on a company's competitive advantage. Investor-friendly management. Businesses with a management that is committed to shareholder value can be attractive to investors. Coca-Cola's long history of consistent dividend payments makes it a favorite pick among income-seeking investors like Warren Buffett. Strong brand name. Businesses with strong brand recognition can maintain market share and command premium prices. Tesla's brand is synonymous with electric cars, and it has built a dedicated customer base that is passionate about the company's mission, and the company can charge premium prices. Loyal customer base. Businesses with loyal customers can generate repeat business and benefit from positive word-of-mouth marketing. Apple's customers are known for being loyal to the brand, they stand in lines for hours and buy every product. High switching cost. Companies that offer products or services that are difficult or costly to switch from can create a sticky customer base. Microsoft Azure Cloud offers complex cloud infrastructure services that require a significant investment of people, time, and money to switch from, making it a challenging competitor to displace. Economics of scale. Economies of scale refer to the cost advantages businesses can achieve as they increase the scale of their operations. Costco's bulk purchasing and efficient supply chain management allow it to offer its customers extremely low prices while making a profit. Network effect. Businesses that create network effects, where the value of a product or service increases as more people use it. It can create a competitive advantage that is difficult for competitors to replicate and move all the users. YouTube is a good example of the network effect. More users bring more content creators, and with more content, it becomes more valuable to all users. Sustainable competitive advantage. Businesses with a sustainable competitive advantage can maintain their market position over the long term. Google's dominance in the search engine. Intellectual property and patents. Valuable intellectual property, such as patents, can create a barrier to entry for competitors. Pfizer's patent protection on its drugs has allowed the company to stay one of the pharmaceutical industry's leaders for several decades. Company invests in R&D. Businesses that invest heavily in research and development can create new products or services that give them a competitive advantage. Amazon's investment in technologies such as cloud computing and artificial intelligence has allowed it to expand into new needs and increase revenue each year. First mover advantage. A business that is the first to enter a market or introduce a new need or service can gain a significant advantage over its competitors. One of the classic examples of first mover advantage is the case of Microsoft Windows. Microsoft established itself as the dominant player in the PC operating systems by being one of the first mover in this space. This concludes our qualitative analysis technique. The third and final technique is fundamental analysis. Fundamental analysis is a method of analyzing a company's financial and economic data in order to estimate its intrinsic value and evaluate its investment potential. Fundamental analysts look at a variety of factors, including a company's financial statements, earnings reports, management quality, industry trends, and economic conditions, to assess its overall health and performance. Some key metrics and indicators that fundamental analysts may use to evaluate a company's investment potential can include the following: earnings per share, a measure of a company's profitability that indicates how much profit it generates per share of stock; price to earnings ratio, a measure of a company's stock price relative to its earnings per share, which is used to assess whether the stock is overvalued or undervalued; price to sales ratio, a measure of a company's stock price relative to its revenue per share, which is used to assess how much investors are willing to pay for each dollar of the company's sales; price to book ratio, a measure of a company's stock price relative to its book value per share, which is used to assess whether the stock is trading at a premium or a discount to its intrinsic value; dividend yield, the annual dividend income a company pays out relative to its stock price, used by income-seeking investors to assess the company's dividend-paying capacity; debt to equity ratio, a measure of a company's financial leverage, indicating the proportion of debt relative to equity, used to assess the company's risk profile; return on equity, a measure of a company's profitability relative to its shareholders' equity, used to assess the company's efficiency in generating profits with its shareholders' investment; free cash flow, the cash generated by a company's operations that is available to be distributed to investors or reinvested, used to assess the company's financial flexibility and growth potential; gross margin, the percentage of revenue that remains after subtracting the cost of goods sold, used to assess the company's pricing power and profitability; and operating margin, the percentage of operating income relative to revenue, used to assess the company's operational efficiency and profitability. Fundamental analysis is often used by long-term investors who are looking to buy and hold stocks for an extended period of time. By analyzing a company's financial and economic data, fundamental analysts are able to gain a deeper understanding of its strengths and weaknesses and make more informed investment decisions. We will study this technique more deeply in our upcoming videos. Let's summarize what we have learned in this video. We discussed three primary techniques: technical analysis, qualitative analysis, and fundamental analysis. Technical analysis involves studying past market data and using charts and technical indicators to identify patterns and trends. The qualitative analysis assesses a company's strengths and weaknesses based on non-numerical data such as market trends and customer preferences. Fundamental analysis involves analyzing a company's financial and economic data to estimate its intrinsic value. Different factors and metrics are used in each technique to evaluate a company's investment potential. That's it for now. Thanks for watching, and don't forget to subscribe to our channel for more informative videos on finance and investing.